Hey investors, are you sometimes torn between chasing growth or securing income? In today's video, we're comparing two popular ETFs, QQQ and QYLD, to help you decide which strategy is best for your portfolio. Stay tuned until the end, where we'll break down their performances and reveal which ETF aligns with your financial goals. Whether you're focused on maximizing growth or securing steady income, you wouldn't want to miss the insights that could shape your investment journey. Let's begin by understanding the fundamental differences between those ETFs and their objectives. QQQ is a growth-oriented ETF that tracks the Nasdaq 100 index. It focuses on the largest non-financial companies in the Nasdaq, making it ideal for investors who want to capitalize on the long-term growth potential of tech giants and other industry leaders. On the other hand, QYLD, the global X Nasdaq 100 Covered Call ETF, is designed for income-focused investors. QYLD holds the same underlying assets as QQQ, but employs a covered call strategy. This means it generates income by selling call options on the Nasdaq 100, allowing investors to earn a high monthly yield, but at the cost of some growth potential. Next, let's discuss the cost of holding these ETFs, an essential factor for any investor. QQQ has an expense ratio of 0.20%, which is relatively low given its focus on high-growth tech stocks. QYLD carries a higher expense ratio of 0.60% due to the additional costs associated with managing the covered call strategy. While this might seem steep, it's important to consider the income it generates in return. When it comes to total holdings and assets under management, QQQ is a powerhouse, with over 100 holdings and more than $200 billion in assets under management, reflecting its popularity among growth investors. On the other hand, QYLD is more modest, with fewer holdings and around $8 billion in assets under management, however, specifically tailored for those seeking income rather than capital appreciation. One of the most significant differences between QQQ and QYLD is their yield and distribution frequency. QQQ offers a minimal yield, as it's designed for growth rather than income. Its distributions are quarterly and are generally modest. QYLD, on the other hand, shines in this area. At a yield of about 12%, it offers a high yield with monthly distribution. This makes it an attractive option for those looking to generate regular income from their investments. QQQ focuses on high growth companies with top holdings like Apple, Microsoft, and Amazon. This makes it a suitable choice for investors who believe in the long-term potential of these tech giants. QYLD also holds these companies, but uses them in a different way. By selling covered calls on the Nasdaq 100, QYLD generates income but sacrifices some of the upside that QQQ investors enjoy. This trade-off is key to understanding the difference between growth and income investing. Now, let's dive into the performance metrics, arguably the most critical aspect of any investment decision. QQQ has delivered an impressive return over the years, with a 1-year annualized return of 23.63%, a 3-year return of 9.63%, and a return since inception of just under 10%. QYLD offers lower returns, with a 1-year annualized return of 12%, a 3-year return of 4.34%, and a return since inception of 7.65%. But to truly understand the impact, let's compare what would have happened if you had invested $10,000 in both ETFs since the inception of QYLD on December 12, 2013. So as you can see here, the average annual total return with dividends reinvested of QQQ is at 18.66%, versus QYLD at 7.29%. So the ending investment of $10,000 after more than 10 years with all the dividends reinvested for QQQ is at $62,337, and QYLD is at $21,225. In the case where you didn't invest any of the dividends, the average annual return with no dividends reinvested of QQQ is at 18.02%, and QYLD is at 4.81%. So that is a significant difference. Ending investment after more than 10 years with no dividends will get QQQ to $58,834 and QYLD to $16,528. This comparison highlights the key difference between these two ETFs. QQQ is all about growth, allowing your investment to compound over time, especially when the market is on an upswing. However, QYLD is focused on income, providing you with regular distributions. In the long term, covered call ETFs like QYLD tend to underperform the underlying market during bull markets because they give up potential upside to pay dividends. However, in a bear market, these ETFs can perform better by minimizing losses through their monthly distributions. So which ETF should you choose? If you're looking for maximum growth and can handle the market's ups and downs, QQQ might be the better choice. It's for those who want to see their investments grow over time with the potential for significant returns. On the other hand, if you prefer a steady income stream and are willing to accept slower growth, QYLD could be more suitable. You'll benefit from regular monthly distributions, but with the understanding that your capital might not grow as fast as it would with QQQ. Remember, there's always some level of risk associated with any investing. So it's crucial to consult with a financial professional to determine which ETF aligns with your personal goals. If you found this comparison helpful, don't forget to like, subscribe, and hit the notification bell so you can stay updated on more tips and strategies to help you achieve financial freedom before and hopefully way before 65. Thanks for watching and keep exploring those dividends.